Oh boy, we're gonna want to buckle up for Thursday. Yeah, it's another report that could really be problematic for the stock market. Let's talk about it. 5:30 a.m. on Thursday, we're going to get some really important numbers. Heads up, we're going on a mommy moon trip for like the next 30 hours here to celebrate the twins we've got coming. Just waiting for a little bit of fog to clear, not here, but where we're going. We're taking off. But anyway, I want to talk about this Thursday number that comes out. It's the quarterly report for GDP annualized. And the expectation right now, the survey, is that it's going to come in at 4.2%. This is double the 2.1% of the prior Q2 annualized number. This is a massive number. And if it's already expected to come in so high. If it comes in even slightly higher, I think markets are going to send those yields right back up. We know Bill Ackman's covered his treasury short, and all of a sudden the 10 years down a bit, back down to 4.85 or whatever. But we have to remember 4.85 is still like 40 basis points higher, 40 to actually probably more like 50, yeah, what were we? We were like 4.2 there for a while. So you're like 60 basis points higher than where you were for a while, 60, 65 basis points. So even after Bill Ackman says, hey, I'm done shorting treasuries, and we see the 10-year go from 5% down to 4.85, this GDP number on Thursday, if it comes in hot, and it's already expected to come in high, right? Like, if the expectation is 4.2, even if it comes in at 4, it's still hot. It's like, what the hell? The Federal Reserve, Jerome Powell just reiterated this last week. They said, we want to see the economy grow at below trend to help prove or ensure that inflation stays low. Now, obviously, it's entirely possible. We know this. We're researching this on a daily basis at our course member live streams or whatever. Like what we were researching this morning with Sherwin-Williams or otherwise. We know the leading indicators of inflation are soft. We know there has been a lot of inflation, but the leading indicators are soft. So what does that potentially mean when Jerome Powell says, well, we want to grow at below trend growth? Well, trend is 2%. So that means we need GDP to come in at, 1.5% growth or something lower. That would hopefully give the Fed the impression that they've done enough to slow the economy. When GDP is growing at 1.5%, some people believe that a slower economy means less inflation. I personally believe that it's entirely possible to have a growing economy and low inflation as you actually encourage innovation and investments. Some of the things that we're seeing a lot of the companies do right now that we're studying is they're not cutting investment spending yet. That's how you get a really dirty, dark recession. That's how you get 2008 over again. When companies get to a level of so much fear that they start cutting and preserving rather than investing. Unfortunately, that's what Elon did, right? Elon pulled the, we're going to slow walk a little bit on the permits for Giga Mexico. I think that's a massive mistake. And we have made that clear already, but I personally think Elon should say something like on an earnings call with like some kind of prepared script or whatever, which I don't have a script for this, but something like, since we agreed to start building Giga Mexico, economic conditions have worsened, interest rates have risen 1.5% or whatever it is. As a result, we are approaching the Mexican government and we're saying, look, in order for us to continue building this, which we want to bring these jobs to your area, we're going to need additional support because the calculus we used then doesn't make sense anymore today. And I think that would send a signal to investors that, look, it's not Elon who's flip-flopping on the decision to build Giga Mexico. It's economic conditions, which are harder. And we are now using that as a tool to negotiate for the benefit of investors at Tesla, for employees of Tesla, and the company of Tesla. That's what you should be getting from a CEO, as opposed to, yeah, we're just kind of going to flip-flop and slow walk this. Sorry, Mexican government. Right? That's what you should be getting. But anyway, when companies exhibit that kind of fear, the true fear that like, okay, we need to cut R&D, we need to cut investments, and they go inward. And that's the kind of GDP compression that you get. In my opinion, you actually long-term delay the slowing of inflation. You long-term delay more disinflation. What does that mean? Over the last 40 years, we have had a deflating economy. The only reason we've had any inflation at all is because we print money. It's all the game of fiat, okay? That encourages people taking on debt and spending, and it's good for politicians. It's all rigged, okay? We get that. So the problem, though, with these GDP numbers is GDP numbers are already expected to come in hot. Even if they miss the downside, they're still going to come in hot. It's going to send a signal, the shell shock through, I think, the bond market and the economy of people who aren't paying attention to these GDP numbers that are expected to come on Thursday. And people are going to go, oh, crap. If GDP is annualized 0.2%, or even if 4% on a miss or 4.5% on a beat, that means the Fed has to do more. And if the Fed has to do more, that means higher rates. And I think the numbers on Thursday could be what actually shoot yields over 5%, and it could be painful for risk assets. But this is where it's kind of like, well, what do you want? I mean, like, on one hand, I actually think a GDP print that's strong is good because it means you're further away from recession. Look at American Express, who reported on Friday that consumer sales are still, like, U.S. consumer purchases are still up 9% year over year. Well, in 2022, we were able to go, okay, sure, your sales are up 9%, but inflation is 9%. Well, now it's like, well, inflation was 4.5%. So you actually still have net growth in the amount of money people are spending. This is weird. We're supposed to be in a recession. We're supposed to be where everybody's tightening, but people still have enough net worth to where they're still spending on stuff. So either the recession is just delayed because of the amount of extra money we have, or we prove to the Fed that inflation is gone with a stronger economy and it's okay to lower rates because inflation isn't a problem. Well, that would be ideal. The problem is you're not going to prove to the Fed that inflation is gone until inflation's gone. Well, at some point they'll pull out flexible average inflation targeting. You really need the 3-month and 6-month and 12-month, all of those moving averages really rolling over, which I think as we get our housing disinflation over the next 6 months. Remember what the Fed said. The Fed said in July, most of the housing disinflation is still ahead of us. That disinflation, that's going to be great. Look, when we can talk housing market, obviously we have a deadline November 1st for HouseHack and investing in HouseHack. But we'll talk housing in just a moment. Let's finish this thought. So what does this mean? Well, I think you have a risk for Thursday, potentially sending yields high, stocks down. We want to pay attention to it. I'll cover it live Thursday morning, 5:30. So mark your calendar for that. We'll see what goes on. I actually prefer, personally, higher GDP numbers, because I don't think inflation is going to prove to be a long-term problem, and I would rather be further away from recession. Because when people hear, oh, we're officially in a recession, sometimes you can self-fulfill a worse recession. Because again, that's when companies say, you know what, we're not investing, we're not innovating anymore for the future. That's when you really get that mindset shift that we have not seen yet in this cycle. That's bad. That's when things get bad. Not great. Okay, so that's Thursday. Now, briefly on housing. Every day, we're studying housing markets in different areas. And what we're consistently finding is that price cuts are increasing substantially for October. We have not yet seen more than about a 5% rollover from summer comps. Like, for example, you look at Fort Lauderdale, which is an area I grew up in. I grew up in Broward County. You look at Broward County, sales prices are actually nicely up year over year. Florida's gotten really good inflow of prices. The question is, does that sustain? Well, this winter will tell us, because what we're finding is prices are already, new pending sales are already 4 to 5% lower than some of the peaks that we had this summer. So is that potentially a sign that housing's just volatile in reaction to rates? Of course it is. And housing is actually going to be, well, not so much existing home sales, but you do get a housing new build contribution to GDP. So we'll see some housing numbers in there, but that's not so useful for actual sales prices for properties. What's more important, though, is realistically, there are a few paths ahead. Something major breaks. Economy goes into quick recession, Fed cuts rates. Hopefully they can, assuming inflation is relatively gone. That I see is mostly unlikely. Then there's the possibility that inflation rolls over very, very quickly over the next few months as housing rental, owners equivalent rents come in low, and you can cut rates more quickly. This leads to a risk rally. It's great for crypto. It's great for stocks. What's probably more realistic is the patient approach, which is the Fed's going to keep doing this. I don't know. Is inflation really gone? And at the same time, the data's like the economy's still got life in it. You haven't fully crushed it, below trend, right? And so you get this nervousness. I actually think this nervousness is a fantastic time to build. And so personally, what I'm doing is most of what I'm spending money on right now is building businesses, whether that's expanding what we can do with HouseHack or hiring. Like, for example, we're still working on building a software dev team. If you want to apply, send an email to jobs@meetkevin.com, include a resume, include a little video. We're looking for a full stack developer, team that could do everything basically. Jobs@meetkevin.com. And we're still investing, right? We're investing not just in these businesses, but other businesses. And I think as long as business owners keep investing, we're good. We're avoiding a recession. Downside is you get business owners like this pizza owner. Yesterday we went to a pizza shop, beautiful location downtown. They opened up in 2019, right before the pandemic, crazy. And I asked him, hey, we were talking about their tenant improvements and their deals with their landlord and that. And I asked him, hey, how have sales been? And he's like, straight down. And so very pessimistic. And small businesses are getting hit the worst by interest rates right now. And so we have to empathize with small businesses who don't have access to a lot of capital so they can grow their businesses. This is where individuals themselves should be investing in their education and building. If you just shut down and don't do anything right now, you're wasting time and you're wasting opportunity. Not as great. But what, in my opinion, you really want to do is build right now. But there are a lot of small businesses who are like, that's great, Kevin, but we can't. We can't take on more debt. Our sales are down. Our revenues are down. This sucks. And so at some point, I think the Federal Reserve wakes up and goes, okay, if inflation is indeed gone, we can lower. The question is when, and that's the problem. It just takes longer. Lauren's point of view on the pizza shop was, well, they should bake better pizza. And I'm like, savage. Anyway, so Thursday, I'll see you at 8:30 in the morning. Let's go take off and go to the mommy moon. See you soon. Bye.